Ken wanted to know if equity markets are richly valued. Is this affecting your family's personal investment approach? Michael.
Yeah, well, the answer is yes. Equity markets are very expensively valued right now. In fact, they're probably valued as high as they've been since 2000, which most of us are old enough to remember was the dot-com bubble and crash. So yes, equity markets are very high. Give you some other examples. Shopify, which has been very popular in Canada, despite the fact that it's down about 26% already from its record high, is still selling at 300 times earnings. So that means that at its current earnings level, it would take you 300 years to get your money back. There's all sorts of examples of things that are, extremely expensive. Tesla, for example, is selling at about 1,000 times earnings. And by the way, the average on the S&P 500 is 22 times earnings. So yes, things are very expensive. Having said that, it doesn't mean that there's going to be a bubble popping anytime soon. Sir John Maynard Keynes, the great British economist, said that markets can remain irrational a lot longer than you can remain solvent if you're betting against them. So I'm not here to say that things are about to crash, but it is a time for being careful.
Thank you.
And that's why, by the way, I presented the sort of investment portfolio based on the number of years, based on your time horizon. Because if your time horizon's long enough, then it doesn't matter as much. You have time to recover from a market crash. But if your time horizon's short, you may not. And people forget that from March 2000 to March 2013, the S&P 500 returned exactly zero. The only thing that returned was the dividends.
Thank you, Michael. Michael, we have a lot of questions.
Uh-oh, we're in trouble.
And
hey, how do you like the hat, Diane?
I love your hat, you know this. I'm going to have to buy one. But I have to say, a lot of people comment, and I like to pass it on to you, Michael, is that they say, congratulations, félicitations, excellent présentation. So I guess people really enjoy it, and a lot of comments along those lines. Now, again, a lot of questions. Another one is, any comments on new cryptocurrency ETF, crypto?
On crypto, sure. Crypto. I've been thinking a lot about crypto. I've tried to understand it and be able to invest in it, and I just can't. Without getting in trouble with anyone, crypto reminds me a bit about religion. Certain religions have some very strong believers, even though the story behind them might be a little bit questionable to others. But there's people who believe, and that's what you have with cryptocurrencies. You got a lot of believers, and some people have made a ton of money in them. Bitcoin hit, I think, $61,000 US of Bitcoin recently. It also dropped 14% on Sunday. So, to me, investing in something like Bitcoin is fine, as long as you realize that it's rather like buying a lottery ticket or going to the casino. Because I don't think it's investing, I think it's gambling. And there's nothing wrong with gambling. Gambling is good. You may make some money. You may also lose your shirt. And I frankly don't know which of those will be the outcome.
Okay, Patricia asked, are mutual funds and ETF fees just at the acquisition when you buy it, I guess, or is it ongoing?
The one-time fee, typically when you buy an ETF, as I said, through a discount broker, there's the one-time commission that is $10 or less. And it doesn't matter how much you buy. You can buy $1,000 or $1 million. If you buy it at one time, typically the fee is $10 or less. There's typically no fee anymore when you buy mutual funds. There used to be, but they've gotten rid of that because nobody was dumb enough to pay them. But there are ongoing fees on both of them called these MERs, management expense ratios. Those go on as long as you own the fund. And as I mentioned, they range from about 0.05% for some broad index tracking ETFs to 2, and even I've even seen 3.5% on some somewhat exotic mutual funds. And they are charged every year that you own the fund.
Okay, Sonia also asked, what are index funds like IT index funds?
Like what? What's it, Diane?
Like TD index funds.
Well, an index fund, as I mentioned, is simply a kind of a fund that tracks whatever index it tracks. And it's the basic difference between what's called active investing and passive investing. Active investing means that you've got somebody making decisions as to what stock should be in a fund. Passive investing, also known as index investing, you simply buy everything that's in the index and you don't try to pick and choose. And so virtually all the ETFs, all the ETF companies offer a variety of index tracking ETFs, and quite a number of mutual funds also offer index tracking mutual funds. As I say, the index trackers tend to be a lot cheaper because there's not having to pay people big salaries to pick stocks. And as I pointed out to you, about 12% of the actively managed mutual funds actually beat the indexes. So it's not very good ratio of success. So that's why index ETFs in particular become very popular.
Now, Angie would like to understand what I guess is the conflict of interest that investment institutions have.
The conflict of interest?
That investment institution have.
Yeah. Well, there's two potential ones. One is that if you are dealing with a broker who's charging you commissions on each transaction, they tend to want to do more transactions to earn more income. So the best way to avoid that is to have a fee-based situation where you're paying a flat fee based on your assets. But there's also been other problems. I'm not saying they exist today, but there have been problems where advisors in different fund companies were getting extra incentives to sell that bank's products, for example. RBC recently got slapped with a multi-million-dollar fine for doing that. It was paying its advisors more to sell RBC funds than to sell other funds. And so that's a conflict of interest. You just have to be very careful. And the easiest way to, as I say, to avoid it is to make sure that you're dealing with somebody who is a fiduciary and that you are working on a fee-based basis only.
Thank you. Michelle asks, can you elaborate on market-linked GIC from the banks?
You know, I really haven't looked into them very much. And I don't completely understand them. So I don't want to comment very much. But I will say this. Anytime the banks come up with some product like that, there are fees involved. You can be sure that the bank is making money. And every time there's fees involved, it's a bigger chance for you not to do as well as you might do otherwise. So I just would be very careful on what fees are being charged for those sorts of things.
Okay. What investment would be best if you have a riff?
Sorry, say that again, Diane.
What investment would be best if you have a riff?
Well, that is a question that would take about an hour to answer. And so what I will do is suggest that you go back to that earlier webinar I suggested about maximizing after-tax and other income, where we talk about, different portfolios that are good for RIFs. But I was having a chat with a friend of mine the other day who was asking a similar question. The thing with a RIF is you've got that mandatory minimum withdrawal. And for most people, that's between 5 and even up to 10% a year of the value of that RIF. And the problem is, what happens if the stock market goes down 20, 30% and you still have to take that money out? You have to sell your investments potentially at a loss. So you need to come up with a strategy that's going to generate income that's going to get closer to those mandatory minimum withdrawals. And that's hard to do today. But there are dividend ETFs, there are real estate investment trust ETFs, there are other things that will generate 4, 4.5%, 5%, which at least gets you closer. Again, don't want to spend too much time on that, but would say to people, go to the NAFR website where you can click on the slides or the presentation for the previous webinar that dealt with that subject.
And Nick, I think we can take about 2 more questions. Nick asked, how does one know whether the yields of an investment will be an income, dividends, or capital gains?
Well, the best way to do it is, if it's an ETF, is to look on the website of the ETF provider, and they will always have one section that talks about distributions or tax information. And if you go there, you'll find out all of that information.
Okay, you mentioned the fee for financial planners that you mentioned. Is this an annual charge on the size of the portfolio?
Yes, exactly. That's the way it works. They charge you whether or not they make money for you or not. They get paid first.
And then the last one, I'm sorry, I won't be, there's a lot of questions. I don't know if we have time, Michael, to finish them all, but
we can do a few more minutes.
Okay,
Diane.
okay, thanks. So the next one is how best to move from index mutual funds to index ETFs. Should we do it all at once, at one time? Will it trigger some funds, capital gains, and so on?
Yeah, well, from the point of view of the overall investment, it shouldn't matter because they should basically be the same thing. But it's just the fees that are different and the triggering of capital gains. So if you're in a registered account, a RIF, an RSP, or TFSA, it doesn't matter because you're not going to see any tax effect. So you can just switch from mutual funds to ETFs. If you're in a taxable account, it does matter, and it can matter a whole bunch. And there you've got to sit down and do a calculation to see how much your taxes would be if you convert it, because you would trigger a capital gain. And if you've got a substantial capital gain, if you've owned those mutual funds for some time, it may not be worthwhile doing. But that's an individual calculation that you have to make yourself.
Okay. Now, this is more complicated. It's a very long question, but I try to summarize it. It says, there's a couple of questions. You described investment percentage allocation based on time horizons. So how do you value our pensions into these allocation? And pension, I say, is like CPP, OAC, and superannuation. Or do you not include them?
Yeah, I haven't included them because, everybody's different and everyone has a different situation. But it's a good question because because we are lucky enough to have our federal pension, we're able to do things, take on a bit more risk that others can't. I have an acquaintance who's a retired CEO of a Canadian company, and he doesn't have a pension. Everything that he lives on is his income from his investments. And I can tell you, he's really very, very concerned these days. And so he can't take the same level of risk that perhaps we can. On the other hand, he's forced to take it because he needs the income. So I don't factor in our pensions into those, portfolios, but I do in the back of my mind keep the fact that most of us have at least a pension coming in that's going to keep us in important necessities of life, even if the stock market tanks.
Now, Sonia wanted to know, could Bitcoin be dangerous to the overall market or economy?
I don't know. I'm afraid that's
very tricky.
Yeah, there isn't, believe it or not, there isn't that much Bitcoin around. I think I read recently the total value of Bitcoin is something like $14 billion. That's a drop in the bucket. Comparatively, I read recently that in the last 6 months, something in the order of $580 billion has flowed into the stock markets. So 14 billion, 580 billion. I don't think it's all that important. What it may be important for more than anything is the emotional attitude of investors. Because if investors get to a point where they, see a major investment falling in value, it can trigger a lot of emotional reactions.
So Michael, do we have time for one more question?
Sure.
Okay. Is Asia, you talk about not focusing only on Canada, but the question is Asia something to focus on, or would world investments be preferable?
Well, I'm a big believer in Asia. I've lived in Asia, traveled extensively in Asia, even though I really am pissed off at China for a whole bunch of reasons right now. You have to recognize that economically that China is soon going to be the most powerful country in the world economically. And for those of you who have not visited China, I can assure you that however you perceive it, you're out by a factor of 1 to 10. It's absolutely unbelievable in China and what's happened there. So I think that when you also consider countries like Vietnam, which have just grown economically exponentially, Thailand, Singapore, all of them, there's an awful lot of growth there. So yeah, I think that having investments through an emerging market ETF, which tend to be primarily focused on Asia, is not a bad idea. If you buy one of these all-in-one ETFs that I was talking about, you automatically get that built in.
Okay, Michael, I know there's a question on stocks, but we didn't really talk about stock in detail, but the question was in terms of there's any strategy for selling stocks that you
the best strategy is sell after you've made a lot of money.
Okay, that's good advice. Okay, well, thank you very much, Michael. As usual, very, very informative overview of some investment option. And as I say, a lot of questions. One of the questions was, how can I get copy of this presentation? And again, as participant, you will receive an email from the Ottawa branch. And in this email, the Ottawa branch will indicate to you where to find copy of this presentation. So if you don't see that email, I suggest that you call the Ottawa branch and they'll be happy to help you. So